Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex language of corporate America, and today we're diving into a treasure trove of fund performance data from Northern Lights Fund Trust. I've got a feeling some of these investment strategies might have you scratching your heads, or maybe even reaching for your wallet, so stick around to see what financial wizardry, or perhaps just plain old investing is really going on. Before we dive too deep into the numbers, if you love getting a clear understanding of what these financial filings truly mean, make sure you hit that subscribe button and ring the notification bell to join our community. We're also building a fantastic community over on Discord, so come join the conversation. A link is in the description below. Alright, so this filing is a certified shareholder report for Northern Lights Fund Trust, and it's basically a financial checkup for several Ladenburg funds like the Ladenburg Aggressive Growth Fund and the Ladenburg Income Fund for the year ending in the summer of 2025. The main point here is to show how these funds performed, what they invested in, and how much it cost investors. Let's jump straight into how the funds performed, because that's what we all care about. Did they make money or not? For the Ladenburg Aggressive Growth Fund Class A shares, for example, the 1 year return without any loads or sales charges was 10-for-5 index, which did much better at 15-16% for the year. It's a pretty clear picture that S&P 500 is outperforming these Ladenburg funds, and that's a trend we see echoed across the different classes, like Class C and Class I, for if you consider the load or sales charge, that same $1,000 only gained about 4.99% in a year. So those sales charges really eat into your returns. Then you have the benchmark, the S&P 500 index, which did much better at 15-16% for the year. It's a pretty clear picture that S&P 500 is outperforming these Ladenburg funds, and that's a trend we see echoed across the different classes like Class C and Class I for the same fund fail. For dollars only gained about 4.99% in the 500, is outperforming the 16% for the year. It's a pretty clear picture. The S&P 500 is outperforming. The Ladenburg Growth and Income Fund Class A also shows a similar story with a 9.15% return for the year compared to the S&P 500's 15.6%. And for Class C shares, the return was even lower at 3.68%. Not exactly lighting the world on fire, is it? Looking at the Ladenburg Growth Fund Class A shares, the 1 year return without load was 10.67%. Again, the S&P 500 crushed it with over 15%. The trend is consistent. The funds are lagging behind the overall market index, which is a big red flag for potential investors. Even the Ladenburg Income Fund Class A shares, which are supposed to be more conservative, had a weaker performance. This Class A had a 9.05% return for the year, while the S&P 500 was at 15-16%. This suggests a consistent underperformance across the board when comparing these Ladenburg branded funds to the broad market index. Now let's talk about the money involved. For the Ladenburg Growth and Income Fund, for instance, the net assets, which is the total value of everything the fund owns, minus what it owes, was a pretty hefty 169,622,832 Forza. However, the number of portfolio holdings was quite small at only 10. This means the fund is very concentrated in just a few investments, which can be risky. Speaking of investments, the top holdings are very telling for the Ladenburg Aggressive Growth Fund Class A. The top holding by a significant margin was the Schwab US Large Cap Value ETF, making up 26.8% of the net assets, followed closely by the Schwab US Large Cap Growth ETF at 23.8%. This shows a strong reliance on these two ETFs for performance. But for the Ladenburg Growth and Income Fund, we see a different picture. The top holding was the Schwab US Large Cap Value ETF at 21.1%, but then it quickly shifts to KIMCO Active Bond ETF at 10.1% and Vanguard Intermediate Term Bond ETF at 7%. This suggests a more balanced approach between stocks and bonds for this particular fund compared to the Aggressive Growth Fund. More interestingly, under asset weighting for the Ladenburg Growth and Income Fund, we see fixed income making up 49.3% of the investments. That's almost half the portfolio in bonds, which aligns with the top holding showing significant bond ETF allocations. This explains why its performance might be more stable, but likely less explosive than an all-equity fund, and certainly less than the S&P 500 RAIM. Now, about the cost you pay to be in these funds. For the Ladenburg Aggressive Growth Fund Class A, hypothetical $10,000 investment cost you $106. For Class C, it was $183. And for Class I, it was $89. This might seem small, but over time, these fees add up, especially when the fund's performance is lagging the benchmark like we've seen here. The percentage paid as a percentage of a $10,000 investment was 1.0 beneath their setup, especially when the fund's performance is lagging the benchmark like we've seen here. The percentage paid as a percentage of a $100,000 investment was 1.0 behind that, on top of underperforming the market, on top of underperforming the market. Let's look at the long-term picture. The Ladenburg Aggressive Growth Fund Class A started at $10,000 in August 2015, and by June 2025 it grew to $2,400 without any load. That's a decent bump, but compare it to the S&P 500, which started at the same $10,000 and ended up at a whopping at $338. That's almost double the growth. The difference is significant and shows that passive investing in an index fund could have been a much better strategy for growing wealth. The Ladenburg Growth Income Fund Class A also shows a similar story, starting at $1,000 in August 2015 and reaching $1,826 by June 2025. Again, the S&P 500 outperformed significantly with $39038. These funds consistently trail the index, which raises serious questions about their strategy and value proposition. Even the Ladenburg Income Fund Class A, which is meant to be more conservative, saw its $10,000 investment grow to $13,422 by June 2025, whereas the S&P 500 turned that $10,000 into $319,000 into $390,000 into $390,038. The gap is enormous and really highlights the opportunity cost of investing in these underperforming funds. Now moving on to the auditor's report, a crucial part of any financial filing. This is what the independent auditors, the folks who check the books, say about the company's financial health. The opinion here from Cohen Amp Company Limited states that the financial statements present fairly in all material respects the financial position of each of the funds. They conducted their audits according to PCAOB standards, which means they didn't just take management's word for it. They dug into the numbers. This gives some credibility to the financial reporting, but it doesn't justify the underperformance we've seen. In another section, the trustees of Northern Lights Fund Trust discussed renewing the investment advisory agreement with Ladenburg Thalmann Asset Management, Inc. This part talks about how good the investment managers are. They considered the experience of the key personnel and the overall investment strategy. The trustees were satisfied with the quality of services, noting a robust and experienced investment team and access to research and technology. This sounds good on paper, but it doesn't translate into market-beating returns. However, when they discuss fees and expenses, a different story emerges. For Ladenburg Aggressive Growth Fund, the advisory fee was bought 50% higher than the category average, and the net expense ratio was also above average. This means you're paying more for services that are not delivering superior results. The report mentions expense limitation agreements and economies of scale, but the core issue remains the same. You're paying a premium for underperformance and Bolwi and annuals of. Looking at the financial highlights for the Ladenburg Aggressive Growth Fund Class A, the ratio of expenses to average net assets before reimbursement was 1.16%, which is quite high, especially considering the poor total returns of 10-40% for the year. The net of reimbursement ratio is 1.8% for the year. The net of reimbursement ratio is 1.0%, which is better, but still significant, given the subpar performance. The trustees concluded that approval of the advisory agreement was in the best interests of the funds and their shareholders. This sounds like a standard legal boilerplate, but given the consistent underperformance against the S&P 500, I'm a little skeptical about how truly in the best interest it is for the shareholders, especially when considering the fees. So what's the overall take on these Ladenburg funds? Well, the financials clearly show a consistent underperformance against the benchmark S&P 500 across multiple funds and share classes, while the investment managers are described as experienced and having good resources. The actual investment results are not impressive. Investors are paying fees for strategies that are not delivering competitive returns. The performance figures and the high fees for lagging results are a notable risk. For any investor considering these funds, the company direction seems to be to continue leveraging the same strategies despite evidence of underperformance, a strategy that might benefit the asset managers more than the investors. What do you all think of these Ladenburg funds? Are you invested in any of them or similar funds? Let me know your thoughts in the comments below if you found this breakdown helpful. Please give this video a thumbs up and subscribe for more deep dives into corporate finance and investment reports. And as always, if you want to join the conversation and get more exclusive content, check out our Discord community linked in the description. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.